normally talk about when two sides to an issue. This time I'm going to talk about one side, but I'm going to give it context. This is important. The person, her name is Taylor Kinney from ITM Trading. She is going to make the case for the fact that she believes, based on historical data, that we are headed for a market crash, a stock market crash. As I listened to her reasons, they actually made sense to me. But what she doesn't do is give it context. So I want to spend this time telling you my view of it, put it in context, and then let you listen to her reasons. I'm Ben Reppond. Today is August 12th, 2025. Thank you for watching my YouTube channel. As I said, I'm going to show you this clip from Taylor Kinney, ITM Trading. Now, keep in mind, and I want to fully disclose this, ITM Trading and her have a bias. They are in the gold business, selling precious metals and gold. And so if she can make the case for the fact that the stock market is going to crash, then it helps her sell gold. Okay, so I just want you to know that up front. And do I agree with her points? I actually do, with a caveat. But she doesn't put a time frame on it. When you listen to this without a time frame or a context, you're oriented to getting scared and, oh, this is going to happen tomorrow, or could happen tomorrow, or next month, next week, next year, whenever. We don't know that. That's the piece that goes unsaid. But one, remember, she has a bias. Number two, here's the context. And that is that I think this is going to happen. You may agree or not, but it's up to you. But I don't think it's around the corner. I don't think it's going to happen this month or next month. But I do think her points are valid, and you can listen and determine for yourself. Therefore, having a strategy, a methodology for dealing with a crashed market. When I say crash, I mean a drop of 40 or 50% or more. When that happens, if you want to ride it all the way down, good luck. But if you don't, you need to have now, not then, but now, you need to think about, how am I going to deal with downside risk? I can go through a lot of scenarios. You could buy gold. That may work, it may not work. You could buy bonds, you could cash, you can put it in a can in the backyard, whatever you want to do. I mean, there's a variety of strategies for dealing with market risk. But you know what? Everything that you do also has risk. So if you go into gold, gold has gone way up, and we're in a period where it has. It's also turned around and gone way down, way down. And so that's not a guarantee that that's going to work. You can say, I'll go into bonds. Bonds have risk. You go, well, what kind of risk? Well, credit risk and interest rate risk. You can say, okay, I want to put it in cash, and I'll put it in under my mattress. That has a risk. That's called inflation risk. So no matter wherever you go, there is risk. And what I'm saying is that I think her point is valid. The stock market does have risk in it, and we are overvalued, and we are due for a correction. And she goes through some historical numbers, but I do think you need to think about that and how you're going to deal with that risk. When that happens, I will be talking about that risk and how to deal with it. It is much smarter, in my opinion, if you want to deal with it now. Say, just plan ahead. How are we going to deal with it when that happens? Our approach is a tactical approach. I believe in the method of just getting out of the way early on, not the first day, but early on. And when it crashes, let it crash. And then when it turns around and comes back up, we get back in. Now, my opinion, that's better than a buy and hold 60-40 stock and bond portfolio. Or it's, in my opinion, better than buying gold as an antidote or bonds or whatever. Each of those have risks that I don't particularly like. The trade-off of risk versus return is what I look for. And my opinion, our approach is the one I prefer. But you need to think about for yourself, what is it that you're going to do? And don't just discount this because she works for a company that sells gold. I do think her points are valid. So her point, a key part of what she's talking about is that the market, what's unusual now is that we have this incredible concentration of stocks that are making up such a huge percentage of the market. For example, it's called the Mag 7, Magnificent 7, but if you extend that 7 out to 10, there are 10 stocks today that make up 40% of the market. 40%, nearly half of the market, 10 stocks out of thousands. Or if you said the S&P 500 out of 500. You could say, what about the other 490? Or what about the other 5,000, or however you want to evaluate it? But 10 stocks make up 40% of the market. And so she goes through some historical comparisons in year 2000. I won't repeat everything she said, but what did it look like then? We are in worse shape. We are at high risk today than we were in 2000, right before the crash, the internet bubble crash, the dot-com crash. And that had a 26% concentration. We have a 40%. The higher the concentration, the further down they fall. That market lost in the tech stocks, which is what it was based on, lost 85% of its value. The ones that were very elevated, just like today, high concentration, very elevated, lost 85% of its value. And then you go back to 1929, which she does, and same thing, high concentration. In that case, the market lost about 90% of its value before it began a process of recovering. So I don't know where we are in comparison to that. I just know that her point is this area of concentration of risk or concentration of assets, whether it be in stocks or indexes or whatever, is risky. And it's great to write it up. And we are writing it up. And if there's, whenever we get to the top, they don't kind of sound an alarm and say we're at the top. It doesn't work that way. But whenever that happens and it starts down, we will get out. Our approach is designed to get out. You have to decide what it takes for you to get out, or do whatever you're going to do. And if you want a 60-40 stock and bond portfolio, go for it. Or if you want some other approach, you want to accumulate $100 bills and put them in a tin can, or you want to buy gold, whatever you want to do, just be comfortable with it and know that being defensive at this point is not a bad idea. Okay, so that's enough of that. It's just a background, give you context and give you the caveat of her bias, and which, again, I think she did a good job of presenting. So you take a listen to this. This is Taylor Kinney, ITM Trading.
I'm going to tell you something that you need to hear that no financial advisor will tell you that is the truth. Every single bubble throughout history has popped. Not some, but all. And the one we are in right now is arguably the largest one yet, meaning that when it finally pops, the fallout won't just be painful, it will be catastrophic. The headlines scream growth. Tech stocks are booming, and everyone you know seems to be chasing the rally. If you dare to question what's really going on under the surface, you're dismissed as alarmist. But yet, over half of the S&P 500 companies have just reported falling profit margins. In fact, if you dig into the profits and where exactly they're coming from, the real picture becomes much clearer. And therefore, we can see not only what's really going on today, but what we can expect to happen next. So I want to start by looking together at the S&P 500's top 10 companies, and I'll explain why. But let's start here with the S&P 500's 10 biggest companies pulling away from the rest of the pack. Doesn't sound too crazy, but it is interesting. Something strange happened about a year and a half ago. Top 10 and the rest were moving kind of similarly. And then in 2024, all of a sudden we have this big divergence, right? The top 10 takes off. Everyone else just kind of remains flat as far as net income growth. Okay, that should make you pause right there. But what else is happening with the top 10? Well, the top 10 stocks push S&P 500 concentration to record 40% in July 2025. Think about that for a second. Is it the S&P 500 or the S&P 10? Top 10 stocks now account for 40%. That's almost half of market concentration. So when we're talking about the stock market being strong or rallies that are happening, are we really talking about a wide swath of stocks, or are we talking about a very select few, the top 10? And just to put this into perspective, when we're talking about 40% today, that's not a normal number. In fact, if we zoom out a little bit and look at today compared to the dot-com bubble, things become very clear. Back in 2000, we have the top 10 stocks as a percent of S&P 500 market cap. It was about 26%. 26% was concentrated in the top 10 companies. Today, that number is 40%. 40%. That's 1.5 times. That's 50% more than it was back in 2000, right before the dot-com crash. That should scare you, because the more concentration we have, the higher risk we have should something go wrong. And again, just to really drill home how unnormal this is, we can zoom out even farther than 2000. Look at this one I found. Market cap weight. Now, this is the top 10%, not top 10, but top 10% of largest US stocks. Today, the last time we saw this same concentration, the closest time would have been 1928, aka the Great Depression. That's the last time we saw as much market concentration as what we're seeing today. This is massive. This isn't any just small thing, normal thing that we're seeing. This is a bubble that has grown so big that, again, by the time it pops, we're not going to know what to do with ourselves. Now, there's a reason why this is happening, right? Because you see all this and you think, okay, well, why are people still pouring their funds in? You might be one of them. I'm sure you hear it from everyone you know, your neighbors, your mailman. Everyone has fear of missing out right now. They're telling everyone exactly what they should do with their hard-earned income, that they have the answers, that they know, that they've been profiting. But they don't know. I mean, maybe they have been profiting. And again, I'm all for making hay while the sun shines, but at the same time, you have to know the risks involved, right? And I think that's where too many people get caught up. It's mania. And there's actually a term for it that was coined by former Federal Reserve Chairman Alan Greenspan. He called it irrational exuberance. Irrational exuberance, aka this is not built on foundation, profit, revenue, margins. This is built on speculation and hype.
Okay, hopefully that was helpful to you. I think she's credible. She is working for ITM Trading, and they do sell gold, obviously. But again, I think her points are valid, and that's the reason I played it. And when you look in YouTube, I'm looking, whatever I'm searching for and I find and I listen to, how YouTube works. Then it starts feeding you other videos like that. So what I see out there, a lot of things, the dollar's going to crash, your 401k, your IRA, your bank account, all of the things that are real estate, these are all ready to crash. Well, we don't know. The people who sell that don't know. But again, I think having a defensive position is part of building wealth and retaining wealth. So I hope that was helpful. Thank you for watching.